Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into one of the hottest topics shaping the global financial landscape: cryptocurrency, and specifically the institutional trends that are going to define this space by 2026. Now, I know many of you listening are already watching the market closely, keeping an eye on the latest Bitcoin ETF news, or perhaps even trading crypto yourselves. But what we're seeing now is much bigger than short term price swings. What's happening is a deep structural shift, the entry of institutions into the crypto space at scale. So, in today's episode, I'm going to walk you through where we are now, what the current institutional adoption looks like, the game changing role of Bitcoin ETFs, and how all of this could transform by 2026. We'll also dig into case studies of the major institutions already leading the charge, the risks that still remain, and of course, what this all means for you as a trader or investor. And before we wrap up, I'll also share some resources for anyone who wants to get practical. Whether you're ready to trade like the pros, or you're just starting to learn about financial markets. So let's get started. The current state of institutional adoption. To understand where we're going, we need to start with where we are. Institutional adoption of crypto has been on a steady climb since around 2020. That's when major corporations and asset managers began taking digital assets seriously. Think back to Tesla making headlines with Bitcoin on its balance sheet. MicroStrategy built its entire corporate strategy around buying and holding Bitcoin. Square, which is now Block, followed the same path. Suddenly, crypto wasn't just for retail traders or small hedge funds anymore. It was something Fortune 500 companies were openly embracing. At the same time, the traditional financial giants got involved. JP Morgan, Goldman Sachs, Fidelity. These names are not just dipping their toes in. They've launched crypto trading desks, built custody services, and started offering crypto investment products to clients. So, as of 2025, institutional involvement looks like this. You've got dedicated custody solutions from players like Fidelity, Coinbase Custody, and BNY Mellon. These solve the problem of securely holding large amounts of crypto on behalf of institutions. You've got derivatives and structured products. The Chicago Mercantile Exchange offers Bitcoin futures and options, and hedge funds use these tools for risk management. Regulatory green lights are coming into place in key markets. The US, the European Union, and Asia are all rolling out clearer rules, reducing the compliance fears that kept institutions on the sidelines for years. And the surveys confirm it. PwC and Fidelity both report that a significant percentage of hedge funds, over 40%, now hold some exposure to digital assets. So we've moved past the point of asking if institutions will adopt crypto. The question is how fast and how deeply. The game changer, Bitcoin ETFs. Now let's talk about the real game changer here, Bitcoin ETFs. If you've been following the headlines, you've seen wave after wave of Bitcoin ETF news. And for good reason. After years of rejections, regulators finally began approving spot Bitcoin ETFs in multiple markets. Why does this matter? Well, Bitcoin ETFs allow investors to gain exposure to Bitcoin without actually holding the asset themselves. For institutional players like pension funds, mutual funds, and endowments, that's huge. They don't have to worry about private keys, custody, or security risks. They simply buy the ETF like they would any other ETF. The effects have been staggering. First, the capital inflows. Billions of dollars poured into US-based Bitcoin ETFs within months of launch. Second, legitimacy. Institutions that were once skeptical are now far more comfortable investing in a product that looks and feels like something they already understand. And third, liquidity. The surge in ETF trading volume has tightened spreads and deepened market depth, making Bitcoin markets more stable. By 2026, it's very likely that Bitcoin ETFs will be as commonplace in institutional portfolios as gold ETFs. And that really is the bridge between traditional finance and digital assets. Institutional crypto adoption in 2026, the scenarios. So, what does institutional crypto adoption look like by 2026? Let's paint a picture. Scenario 1. Crypto becomes a core allocation. Digital assets could evolve from being alternative investments to being part of the core allocation in diversified portfolios. Just like gold is a staple for risk management, Bitcoin and Ethereum could become permanent fixtures in pension funds and sovereign wealth strategies. Fidelity already reports that more than 70% of institutional investors are planning to invest in crypto long term. Imagine what that number will be in 2026. Scenario 2: the rise of tokenized assets. This one is really exciting. Beyond Bitcoin and Ethereum, we'll see the tokenization of real world assets, bonds, equities, even real estate. BlackRock has already piloted tokenized money market funds. JP Morgan has its blockchain settlement projects underway. By 2026, tokenization could unlock trillions of dollars in liquidity, letting institutions trade fractional shares of assets that were once highly illiquid. Scenario 3: CBDCs and stablecoins. Institutional adoption won't be limited to volatile crypto assets. Stablecoins and central bank digital currencies, CBDCs, are going to be key. Think about cross border settlements, treasury management, and payments. Visa and MasterCard have already tested stablecoin settlements. By 2026, stablecoins like USDC or government issued CBDCs may become standard for global transfers, cutting settlement times from days down to seconds. Scenario 4: DeFi integration. Decentralized finance is going to mature. We'll move away from speculative protocols and meme coins into institutional grade lending, borrowing, and settlement platforms. Aave Arc has already launched permissioned DeFi designed for institutions. By 2026, we could see regulated DeFi pools that rival interbank lending markets in size, but with greater transparency and lower costs. Scenario 5: ESG and green crypto. And of course, we can't ignore ESG. Environmental, social, and governance standards are shaping finance everywhere. Bitcoin mining has already shifted. More than 50% of energy used in mining now comes from renewable sources. Combine that with blockchain's transparency, and suddenly crypto aligns far more easily with ESG mandates. This could unlock billions in ESG focused institutional capital. The key drivers. So, what's driving all this forward? A few big things. Number 1, regulatory clarity. This has always been the single biggest barrier. Institutions can't take on regulatory risk. By 2026, comprehensive laws in the US, Europe, and Asia should shrink that burden and open the floodgates. Number 2, risk management tools. Hedging instruments, insurance products, and custody services keep getting better. As the market scales and volatility dampens, institutions gain confidence. Number 3, technology and infrastructure. Blockchain scaling solutions, interoperability between networks, and better custodial tools are all reducing operational friction. And number 4, the generational wealth shift. Younger investors who are inheriting wealth are tech savvy and expect crypto exposure in their portfolios. Institutions will have to meet that demand. Bitcoin ETFs as the gateway. Let's circle back to Bitcoin ETFs for a moment because they really are the gateway. Institutions trust ETFs. They're familiar, liquid, and tightly regulated. By 2026, we're going to see ETFs expand beyond Bitcoin into Ethereum and eventually into diversified crypto indexes. Some ETFs may even include staking rewards, giving investors passive income strategies. For many institutions, ETFs are simply the easiest way to enter crypto without changing how they operate. That's why they're going to be the primary driver of inflows in the next few years. Case studies: who's leading the way? And we're already seeing this play out. Look at BlackRock, the world's largest asset manager. They didn't just launch a Bitcoin ETF, they put their reputation on the line by doing so. That's confidence. Then there's Fidelity. They offer crypto trading and custody services, and they've even integrated Bitcoin into retirement accounts. Imagine 401k plans with Bitcoin allocations. And of course, Goldman Sachs and JP Morgan. Both have entire digital asset divisions serving institutional clients. This isn't experimental. It's strategic and it's serious. Risks and challenges. Now, let's be realistic. There are still risks. Regulatory reversals are always possible. A change in political climate could bring stricter rules. Market volatility remains an issue. Institutions want stability, and crypto still has dramatic price swings. Custody hacks are always a concern. Even one high-profile breach could slow adoption. and reputational risks linger. Some investors still associate crypto with speculation or illicit activity. Institutions will tread carefully, but overall, the trend is undeniable. The investor's takeaway. So, what does all of this mean for you, the trader or investor? Institutional adoption is a double edged sword. On one side, it brings price appreciation, deeper liquidity, and lower systemic risk. On the other side, Wall Street's involvement could centralize power in a market that was originally designed to be decentralized. Either way, the message is clear. Crypto is not going anywhere. By 2026, institutions will be leading the charge, and the markets will look very different from today. Call to action. Now, if you're listening and you're ready to trade with the same efficiency and professionalism as institutions, you need the right tools. Check out crystalballmarkets.com's world-class, cutting-edge, user-friendly trading platform app. It's designed for traders who demand speed, reliability, and usability at the highest level. And if you're just getting started and want to learn the fundamentals, education is key. I highly recommend the Crystal Ball Markets podcast. It's beginner-friendly and covers trading, investing, macroeconomics, and financial markets in a way that's easy to understand. Perfect for building your knowledge before you dive into trading. Closing. So, to wrap things up, by 2026, institutional crypto adoption will likely be one of the defining stories in global finance. With Bitcoin ETF news making headlines and tokenization reshaping capital markets, the stage is set for digital assets to sit right alongside stocks, bonds, and commodities in institutional portfolios. The future of finance is being rewritten right now, and institutions are at the center of it. I'm Sophia, and this has been Financial Market Insights for Traders. Thanks so much for tuning in, and I'll catch you in the next episode.